Hi and welcome to this week ahead analysis video brought to you by Blueberry. Some interesting data on the cards for this week, including the New Zealand interest rate decision expected to see a decrease in interest rates by 25 basis points, bringing the target rate to 3.5%. We also have the US FOMC meeting minutes this week. And then we have US core CPI and CPI data coming in on Thursday. Core CPI expected to jump up to 0.3%. CPI expected to come in lower, which is expected considering where oil prices have been recently. Friday, we then have GDP coming out of the UK, as well as US consumer sentiment. Now, this could be largely overshadowed again by what the market is digesting at the moment. Now, this is the CME Fed Watch tool on the left-hand side, and the US dollar index futures on the right hand side. Now, there's been some real changes to this now. Obviously, last week we had Donald Trump announcing tariffs across all sort of goods coming into the US, and some really big ones in terms of targeting sort of China, Taiwan, Singapore, places like that, especially those that have sort of advancements in sort of tech when it comes to sort of semiconductors and advanced microchips. Places are getting heavily tariffed, as well as we've seen tariffs added to multiple different nations as well. And what we saw was that created this weakness in the US dollar initially, which saw dollar index fall quite considerably towards these kind of demand zones around that 100 level. But what was also interesting is the pricing of cuts by the bond market. So bond market last week actually had an 81.5% probability of no change in interest rates. That has changed now. It's come down to 66.7. So bond markets are now starting to get towards more that sort of 50-50, or whether the Fed will cut in May or not, especially when you go and take a look at sort of US bond yield pricing at the moment. Bond yields have been falling fairly aggressively. What else happened last week? Well, we saw the volatility index jump from sort of high to low 20s all the way up into 45.30. This is the sort of one of the largest moves since 2020. Obviously, we had this one here in 2024, but that was a quick rebound after some sharp negativity there. But look at that close, very, very strong close. If this sentiment continues and we see the volatility index continue to kind of drive higher here, push towards these kind of 60s, then this kind of market narrative that we've got at the moment could potentially continue, and we could see it move a lot further. Let's talk about oil prices. Oil prices detrimental to global trade. Closed significantly lower last week, closed at 62.49 on this particular chart here, breaking through these considerable lows that were formed at the $67 handle. Why did we get this? Well, obviously it can tell us two things. First of all, usually oil can fall quite aggressively when there's a lot of fear in the markets, as it's technically a sort of commodity, risk-based commodity. It reacts really well to sort of risk-on, risk-off sentiment, and we've seen oil prices decline quite rapidly over the last week or so. It wasn't really helped by the fact that OPEC also announced that they were increasing their production output. So you've got the US that are increasing their production, as well as OPEC nations as well, and that could create quite a bearish sentiment here for oil prices in the near future. Let's have a look at dollar yen then. So typically when we see fear rise in the markets, Japanese yen can be a benefactor of that. Dollar yen fell from around 150 all the way down into the low 145 level. Did get a bit of a rebound coming in on Friday, but if we take a look at the US 10-year yield, which has a very strong correlation with dollar yen, we can see that this was also aggressively down, trading around 4% at the moment. If that breaks 4% and we see a continuation to the downside, I imagine dollar yen will continue to flow lower as well, heading back down to that 145, potentially back towards sort of 140.50 lows that formed in September of 2024. Let's take a look at the Nasdaq then. So tech stock market driving lower at the moment. I mean, when you look at it on this kind of monthly scale, it doesn't look that dramatic. You know, we can see that market is very bullish, has been very bullish for a number of years. You know, we had one bearish year, which was sort of 2022, when we had that higher inflation and higher interest rates. As those started to kind of come down, or the narrative changed, and we started to see that move down, you know, we had this really nice bullish channel form within the market. We have now breached that. We breached that prior month, and now in April already, we've already seen a decline of around 9.9%. Sentiment here is just bearish, isn't it? I think we're going to see a continuation of that bearishness, perhaps down into this 16k level. Now, this level holds some extreme weight. You know, it was the 2022 highs. It was also the highs here that formed between sort of 2023 and 2024. We also have confluence with the 50 moving average. Now, you can see how price reacted to it in 2022, and it remained above it and broke and continued higher. So this could be a good little area for those sellers that have been aggressive in this area here to kind of stop selling as aggressive as price reaches quite a significant point. So very interesting market setup this week. Definitely want to continue to kind of try and trade safely as the market continues to digest the narrative of tariffs from President Donald Trump. If you enjoyed that content, please follow and subscribe for more, and I'll speak to you soon.